Welcome back to Plan Life Right. I'm Kevin Ross.
And I'm Matt Floyd. And before we start, I want it on the record that I did not know this episode was about me specifically.
It's not about you specifically. It's about the 11 million other people who do exactly what you did this morning.
That's somehow worse.
All right, walk me through it, Matt. What happened with the Tylenol?
Well, I had a headache. I went to the pharmacy. I paid with the HSA card because, that's what the card is there for, right?
That's what everybody thinks the card's there for.
But it's not.
Well, it's what the card can do. It's not what the account is actually for if you're using it well.
Well, now I feel like I've been driving a sports car in first gear for 10 years.
That's not a bad way to put it, actually. A family that maxes out their HSA every year and just lets it sit and grow instead of spending it on every copay over 30 years at a normal market return, that's over $800,000. Tax-free.
Wow. $800,000 from an account I associate with buying Advil.
Yeah, from that exact same account. All right, so today, what the HSA actually is, why it's the only account in the entire tax code with 3 tax breaks instead of 2, and the strategy that turns it into the most efficient retirement account most people will ever own. All right, so here's the setup. You qualify for an HSA. If you're on a high deductible health plan, this year, that's a deductible of at least several $100s for an individual, $3,400 for a family.
Which is more people than you think, right? I mean, since a lot of employers default to these types of plans now.
Right. And once you're in that account, it does 3 things at once that nothing else in the tax code does. So here's how it works. Money goes in pre-tax, it grows completely tax-free, and it comes back out tax-free.
Right.
As long as it's there for qualified medical expense.
Wait, so say that middle part again. It grows tax-free, not tax-deferred. This isn't a secret 401k.
That's right. Yeah, that's tax-free forever. Not a pay it later, never.
Okay. So a Roth IRA does 2 of those 3, right? It's tax-free growth and withdrawals, but it's after-tax money that's going in there.
Yeah, exactly. The HSA gets you to the deduction you're going in and then the tax-free treatment coming out. Nothing else stacks all 3
levels.
Okay. Yeah.
So why does it have the reputation of being the boring copay account instead of the thing people brag about at dinner parties? I don't know. I've never been where somebody's like, I finally hit this in my HSA balance today. I've never heard that out loud.
Yeah. That's because the card makes it feel like a debit card, and most people never look past the card. Okay, here's the move almost nobody uses, and it's the one that turns this from a medical account into a retirement account. Look, there's no deadline on reimbursing yourself for medical expenses from the HSA.
None? Like ever?
As long as the expense happened after you open the account, you can wait 20 years to pay yourself back tax-free and let the money compound the whole time.
Okay, I want to push on this because it sounds a little too good to be true. What's the catch? There's always a catch.
Well, the catch is just discipline. You have to actually keep the receipt and have other money to pay the bill out of pocket in the meantime.
Okay. So it's not a loophole. It's just that most people don't have that patience to leave the money alone for 2 decades.
Exactly the catch.
Okay.
No trick to find. It's just behavior, actually.
So what should I have done this morning instead of just swiping my old HSA card?
Pay cash or use a regular card. Snap a photo of the receipt. Drop it in a folder. And let those HSA dollars set and invest. Then in retirement, you reimburse yourself for that exact $4 Tylenol purchase tax-free, except now there's the compounding growth that's been riding alongside it.
So my headache today is secretly funding part of my retirement.
Yeah, if you've done it right, of course, yes.
So I'm starting a folder the second we're done recording this. For sure.
This year, the limit is $4,400 for an individual, $8,750 for a family. Add $1,000 more if you're 55 or over.
And both spouses over 55 can each do that to catch up. It's not a combined.
That's right.
Okay.
They need to have separate accounts to do it, which some people miss.
Right. They
One's
set up
doing
that
it,
family one.
yeah, and then the other one's not. They both need to set their individual.
Okay.
Okay, at 65, two things happen, and one of them surprises people. The day you enroll in Medicare, you can't put new money into the HSA anymore.
But whatever's already in there?
Stays yours.
Okay.
It's in there.
Okay. Good.
Keeps growing. Spendable, tax-free on medical expenses for the rest of your life.
And that compounding continues too.
That's exactly right. And the list of what qualifies expands. Now, Medicare, Part B, Part D, Medicare Advantage premiums, all payable tax-free from the HSA.
And that connects right back to the IRMA conversation we had a few weeks back. You could pay that whole surcharge from the HSA and it wouldn't even register as income.
It doesn't count toward income at all, which means it doesn't push you towards the next IRMA here either. Same dollars doing two jobs. Okay, one thing I want to be precise about, because almost every article on this, I think, gets it wrong.
Go ahead.
Medigap premiums, the supplement covering what Medicare doesn't. Guess what? Those don't qualify.
Wait, really? Part B counts, Part D counts, but the supplement filling the gaps in between in both, that doesn't count.
That's it. The IRS drew the line there specifically, and I don't have a real good reason why. It's just the rule.
It's just the way it is.
Exactly. All their other crazy
There's a lot of
rules.
things with the IRS. It's just the way it is.
Yeah, or any government thing.
But that's the kind of detail that can ruin someone's plan if nobody tells them.
Which is why I'm saying it slowly on purpose right now. Okay. One more thing about the post 65 version, because it has a built-in fallback that I like. Before 65, a non-medical withdrawal costs you tax plus a 20% penalty. Okay. After 65, the penalty disappears. You still owe tax on a non-medical withdrawal, but there's no penalty.
So at that point, it just acts like a regular IRA if you don't need it for medical stuff.
Yeah, exactly. Worst case, it's a traditional IRA. Best case, it's a giant tax-free healthcare fund.
So there's no version of this where the money's wasted.
That's why I keep saying it's the best account in the tax code, and nobody treats it that way. Practically three things, okay? One, check whether your HSA balance is actually invested or just sitting in a money market account doing nothing.
Most custodians let you invest once you've got 1,000 or 2,000 sitting there, right?
So move it. Treat it like a retirement account. Two, pay out of pocket for anything you can afford to instead of swiping that HSA card. Start the receipt folder. Matt's apparently starting it right after the
I'm
show.
going to get a paper folder. Like actually make
You're
it
going
legit.
old school. Then you're going to misplace it. It's going to be in a file cabinet. You're
I'm going to get a paper cut.
70 years old.
I'll remind
Where is
myself
it?
not to use my HSA card for Band-Aids.
There's all these bills in here. What is this for? I can't remember.
I'm actually probably going to do it in my notes app.
There you go.
Yeah. I mean, taking pictures goes from phone to phone. I'll be 80.
It's
I'll
in the
be pulling
cloud.
this stuff out. Yeah, it'll just be up in the cloud.
You're Kamala. You're looking for the clouds up in the sky.
This guy buys a lot of Tylenol.
Okay, three, max it out every year if you can. Reducing this year's taxes and building next decade's healthcare fund all at the same time. PlanLifeRight.com. Take the retirement income scorecard. It's free, 7 minutes max. It checks whether your healthcare costs are built into your plan, including whether an HSA strategy could be covering part of it tax-free.
Yeah, because if nobody's modeled that for you, you're planning to pay those costs out of the same account you're counting on for everything else.
PlanLifeRight.com. Go check it out.
And for advisors, be honest, how many client HSAs have you actually seen invested versus just parked in cash?
Yeah, most of them cash. Nobody ever told a client it could be more.
And the advisor who walks them through the receipt strategy and the Medicare overlap is handing them something they've genuinely never heard before.
AdvisorRescue.net. Well, they'll give you the framework for that conversation. Short conversation, but it's a long payoff. Next week, we're picking a fight with an entire generation of financial advice.
That's going to be fun. And it sounds like it's going to be something that gets me emails for sure.
I'm hoping so. It's going to get some emails, I think. The 4% rule, the thing every retiree's been told is gospel, and why the guy who invented it doesn't even use that number anymore.
Wait, the guy who made up the rule doesn't even follow his own rule?
Yeah, it's not even close. Next week, the 4% rule's dead, and what actually has replaced it. Life happens fast.
Make sure your income's ready for it.
I'm Kevin Ross.
And I'm Matt Floyd.
This is Plan Life Right.